Promoters, entrepreneurs, and young guys. So my name is Ram Mundra, and I got 40 years of experience in the field of finance, business strategy, and in the management field. So I thought, let me share my experience with all of you, uh, and so that it can be useful when you run your own business. And I'm sure if you take your notes, if you follow some of these, then you are going to prosper in your business. And I'm sure you are going to grow. You are going to take your business to the next level. And when you grow in your business, more and more vendor, suppliers, customers will be associated with you. And as a result, you will employ more people and it will generate employment in the country. And this is what is the need of our in this country. So moving on, uh, by end of the session, uh, you will learn, basically the three financial statements which are important, very important in any business, which is profit and loss account, cash flow statement, and balance sheet. So basically, balance sheet is nothing but picture of your financial health of your business, and we are going to discuss, we are going to learn how to read these three statements, which are very, very, very important in your business. So, yeah, here we go. So, let us start with a simple question. Suppose someone, anybody, offers you two businesses which are given in the slide, business A and business B. In case of business A, there is annual profit of $150,000, whereas the money available in the bank is only $3,000. In case of business B, the annual profit is about $70,000, but the money in the bank is $250,000. Which business would you buy? So I think most of you must be thinking that the cash is king, and if you have money available in the bank account, then obviously so many things can be done. The business can grow, and it is very important to have the money in the bank account. You are right, but there could be even more smarter people, more smarter entrepreneur who might do a trick, who might do the business differently, and they might go for business A, where they would convert the annual profit of $150,000 into the bank account year on year. So both the answers are correct, and the business is business, and if the profit is not profit, if it cannot be converted into bank account, because ultimately non-recoverable money, non-recoverable receivables will be bad debt, and bad debt will be charged to profit and loss account. Yeah, moving on, see the slide in front of you. If you could start a new business tomorrow, say today, what would it be? Whether it would be a coffee shop, food truck, online clothing, software company, landscaping business, and so on. So, your answer may be any business, right? But one thing is sure, one thing is doesn't change, that uh, the cash flow should be sound, profit and loss should be positive, there should be handsome profit, and the balance sheet should be healthy, right? So every business may look differently, but every successful people speak the same financial language, correct? Which is the uh, healthy profitability, healthy cash flow, and sound balance sheet. Let's move. So now this is the story time. I thought of putting more and more some stories and numbers into my presentation. So it will, I'm sure it will be interesting. What promise you need to do with me, that you will see this presentation till end. If you want to take maximum advantage of this presentation, then you need to do a promise that you will stay with me till end. So you are running in this example, you are running a coffee shop and a neighboring company, gives you an order of $20,000 for supplying a breakfast, right, to their employees on a daily basis. Great, you got an order of $20,000. Let's see what happens this month. It is a great order, isn't it? $20,000 is good money, big money. Okay, so you sold during the month, $20,000 is your revenue. Then you spend for coffee beans, payroll, and all those expenses. $16,000 you spent, and you made handsome profit of $4,000. For $4,000 on 20,000 is a good profit, isn't it? No business would give this kind of profit, good 20%, right, in a month. So this is a successful month, isn't it? Let's see. Next week, you will pay employees their salary, rent to the property owner, suppliers, utilities. Your customer will pay you in 30 days. Okay, because you supplied every day. Okay, and you will raise invoice once in a month. Okay, and then after 30 days, the money will come to you. So basically, first 30 days of the supplies and the next 30 days of the next month, the money will come in the third month. Say if everything is okay, maybe on first. Okay, so in this case, there is a complaint from the customer that part of the order was supplied incorrectly. They asked for thing A and you supplied thing B. And another customer of yours also needs another 30 days to pay you. So you did not receive money, but your business has made profit. Okay, good 20% profit. Let's see. Profit is there, but your bank account is almost empty. Can you pay your employees? Answer is no. Can you pay your suppliers? Again, the answer is partly yes, maybe to some suppliers, but not to all the suppliers. This is how the business fail, right? Mostly the business fail because of cash flow. So what is the lesson we are learning here? Profit is not cash. Business survives on cash, not on profit shown on paper. So here we go. Every business got three stories. Story one, profit and loss account. Story two, cash flow. And story three is balance sheet. And every business should answer these three simple questions. What are three simple questions? We are going to learn in subsequent slide. But there are three stories and there are three questions which we should go through and answer to ourselves. When I say ourselves means the promoter or entrepreneur or the founder should ask themselves at least once in a month. So story number one. Story number one is nothing but a profit and loss account. The question is, did I make money this month? Okay. So here is an example. You run a online coding academy. Okay. This month revenue is 15,000. You spent $10,000. Okay. Say it's there on the screen. Instructor payment is 6,000. Software subscription is 1,500. Marketing is 2,000. Internet and office expenses is $500. So you made good profit, $5,000. In the previous slide, you made 20% profit in that example. Here it is 33%, $5,000 on 15,000 revenue. Is this profit? Is this business profitable? Of course, yes. Not yes, big yes. Does that mean there is a $5,000 in your bank account? Yes. If fees from all the students received in your bank account, what is important is whether the money received in your bank account. Let's see. So we have seen the story number one, profit and loss account. Revenue was there, profit made, but money will come into the bank account when you received all your revenue into your bank account. Means money received from receivables against the sales. Now story two. What is the question in story two? What does my business own today? What does it owe? Means we are talking about balance sheet. We have discussed about the balance sheet earlier in this first or second slide. That balance sheet is nothing but a picture of your health, of your financial health of your business. So think of balance sheet And this is a photograph of your business as of today. Balance sheet is as of always on a particular date, right? So this is your assets. You have a cash of $25,000 in bank account, inventory of $40,000, assets which is computer and equipment of $10,000, and customer yet to pay means you sold on credit and money is yet to receive. It's $15,000. So total assets is about $90,000, and it has to be represented by your equity and the liabilities. So your liability, say credit card balance, you are running a small business, so $8,000, and you have taken the bank loan also, maybe overdraft or cash credit or something, is about liability is $30,000, and your accumulated profit and the capital which you invested is $60,000. So total liabilities and net worth is $90,000. So assets were 90,000 and the liabilities plus owner's equity was 90,000. So balance is 10 each. So just a simple question: which of these an assets? A, B, C, D: cash, credit card balance, payroll expenses, utility bills. So credit card expenses is a liability, payroll expenses is an expense, and the liability because you need to pay utility bills and expense and liability. And answer is a cash, which is your asset. Let's come to the story number 3. Cash flow statement. Again, there has to be question. So question is how much money you actually came in, went out of my bank account during this month. So this is the most important report of your survival, and when your business survives, you will survive as a promoter. Correct? So again, example. Imagine you sell products on Amazon. Your sales for this month is $40,000, and Amazon end of the month transfers you $28,000 only. Why? Because some customer has not paid yet. There are some returns, defective product, or say any other reason. Amazon deducted some commission or maybe some advertisement charges. So here there are questions. Did you sell material worth $40,000? Answer is yes. Did you receive $40,000? Answer is no. So if you don't receive this $12,000 at all, then your P&L will also get impacted, because whatever profit you made, $12,000 is bad debts. So you have to reduce your profit by $12,000. So your cash flow is not $40,000. Case incoming cash, which is cash flow, is only $28,000. So what is profit? Let's compare both profit versus cash. Profit shows whether the business made money, or cash shows how much money is actually in the bank. Profit includes the sales made on credit also. The cash includes only money received. The profit measures business performance. The cash measures business is alive or not. Basically, the health of business. Profit looks good on piece of paper. The cash keeps the doors open. Otherwise, the door will get closed. Okay. So, what is the key takeaways? Did I make money? Look at your P&L account. If you want to see, did I make money in this month? What do I own and what do I owe? Okay, look at your balance sheet. Do I have enough money to pay next 1 month, 2 months, 3 months expenses? Look at your cash flow statement. If you don't understand these 3 reports, then you don't understand financial health of your business. And it's very important to understand all these 3 statements, which we are learning today in this session. Yeah, having gone through all these slides, now we are fairly understand what are these 3 statements. I thought let me put up a case study. So there is a ABC Trading LLC, which is a trading company of household product. And let us make profit and loss account, balance sheet and cash flow statements. However, the profit and loss account, balance sheet and cash flow statements are made through accounting system. But here, just to learn, we are not getting into the accounting system. We are trying to understand from as a top view. Okay, so therefore I'm giving you some situations, I'm giving you some numbers, and after we go through the numbers, we will make profit and loss account, balance sheet, and cash flow. So capital introduced by the owner is $100,000. Bank loan received is say $50,000. We purchased some assets of $25,000, $10,000 for office furniture, and $15,000 for computers and laptops. Now there are few more numbers. Purchase goods purchases for resale is about cash purchase is 30,000, trade purchase is 90,000, total purchases is $120,000, and closing inventory is $25,000. Right? Few more numbers. There is a sales of $250,000. So cash sales is $80,000 and credit sale is $170,000. So total sales is $250,000. And customer paid out of the credit sales of $170,000. Customer has paid is US dollar 150,000. Payment made to suppliers US dollar $70,000. There are operating expenses 63,000 for the month for the period, and it has been all expenses have been paid for. Other transactions is like loan repayment of $10,000, interest paid on loan is $3,000, and owners withdraw money about $8,000. Right? So let's make a profit and loss account. The total sales was $250,000. The cost of goods sold is $95,000. $95,000. So there is a gross profit, which is $155,000. Operating expenses $63,000. So therefore, the operating profit, gross profit minus operating expenses, is operating profit is $92,000. This is also called EBITDA, EBITDA. So interest, since we have taken the loan, interest has been paid $3,000. So the net profit is about $89,000. So there are points here, few points. So total, the sales basically generates revenue, and then cost of goods sold is deducted to arrive gross profit. Business expenses are deducted because they are related to business. They helped earn the revenue. Interest is a finance cost, so it's deducted after operating profit, and remaining amount is a not profit. So this is how we made the profit and loss. Yeah. So I'll be giving you a few more numbers so that we can make a balance sheet and cash flow. Profit and loss account we already made, right? So account receivable, so credit sales was $170,000. Customer has paid $150,000 out of the credit sales. So therefore the closing receivables is $20,000. Accounts payable, we had cash purchase, credit purchase of $90,000. We made payment to suppliers $70,000. So therefore the balance is $20,000 as a liability. And so if we calculate how much the cash has been received during the period, $100,000 was from owner's capital, bank loan was 50,000, cash sales was 80,000, collection from customer 150,000. So total money received is 380,000. How much the cash has been paid? Furniture 10,000, computer 15,000, payment to supplier 70,000, expenses has been paid off 63,000, loan repaid $10,000, interest 3,000, and the promoter withdraw money out of the money which they have invested $8,000, and the total cash outflow was $209,000. So the closing cash as on the balance sheet date is $171,000. So this is the balance sheet. Current assets nothing but the liquid money available with the company, or the assets which can be converted into liquidity or cash within 12 months from the date of balance sheet. Okay, so if I'm preparing balance sheet today, within 12 months, those assets can be converted into liquidity or can be converted into cash, and cash can go to bank account. Those are called current assets. So 171,000 is cash available, account receivable is 20,000, inventory is 25,000. So total current assets is $216,000. We have seen the assets of $25,000. So total assets is $241,000. This $241,000 has to be represented by liability and net worth. So here we go. Liabilities is $20,000 is accounts payable. Bank loan we raised $50,000 loan, $10,000 we repaid. So balance is $40,000. So total liability is $60,000. The owner's capital and the accumulated profit is, so this is the new business. So the profit is for this year $89,000. And so capital was $100,000 and promoter taken back money, which is drawings, withdrew $8,000. So $181,000 is the net worth, which is a closing capital, you may call it. So total $241,000. Yes, slide 241,000, and this is also $241,000. So here we have, for our better understanding and make it simple, we have avoided two things. One is the income tax we have avoided. We have not calculated the income tax. And second, the depreciation on the fixed assets we have not calculated. Okay, let's move on. Now let us make the cash flow. So there are cash flow basically in three parts. One is the cash flow from operating activities. Second is the investing activities. And the third part we will discuss in the next slide. So first is from operating activities, the cash issued from customer 2,30,000, cash paid to suppliers 100,000, operating expenses we paid 63,000, and interest paid $3,000. So we generated cash from operating activities is $64,000. Just mind you, the net profit was $89,000, but the cash was only $64,000 because some of the money out of the credit sales is not yet received. Part two is a cash flow from investing activities is $25,000 is minus because we invested money in fixed assets. Part three is cash flow from the financing activities. So $100,000 capital introduced, $50,000 loan taken, out of which $10,000 has been paid, $8,000 has been paid back to promoters, to founders as drawings. So net received is $132,000. So total cash available is 1,71,000 we have seen in the balance sheet, and here is the break. 64,000 we earned out of operating activities, negative 25,000 because we invested money in investing activities, which is furniture, fixtures, and computer laptops, and financing activities like $132,000. So this is the third statement is the cash flow. We have seen profit and loss account, balance sheet, and cash flow. All three we have prepared ourselves. This simple example. So basically, by now, I'm sure all of us or all of you who is watching this video, by now they have the better knowledge of all these statements and what is the role of all these statements. They must have understood by now. However, if you want to understand it more, you can give in comment box. You can give your comments, and I'm surely will go through and try to answer those questions if you have any. So finally, the revenue is a vanity, profit is a sanity, and the cash flow is a reality. What is reality is the cash flow. Your sales make a business look very, very successful. It looks successful, but cash keeps it successful. So cash is king, as we say from last many, many years. And thank you so much for spending time with me, sparing time for this presentation. This is my first presentation. I would invite your suggestions and comments. How it can be improved on what are the various other subjects where you think that I should be posting such videos. Thank you so much for watching and see you in the next class, class number 2. Thank you so much once again. Thank you.